Well, I'm Joginder Rana. The topic for our discussion today is crop insurance in India. Crop insurance in India. Crop insurance is purchased by agricultural producers, including farmers, ranchers, and others, to protect themselves against either the loss of their crops due to natural disasters such as hail, drought, and floods, or the loss of revenue due to declines in the prices of agricultural commodities. So, agriculture in India is highly susceptible to risks like droughts and floods. It is necessary to protect the farmers from natural calamities and ensure their credit eligibility for the next season. So, for this purpose, the Government of India introduced many agricultural schemes throughout the country. Crop insurance is one such scheme. There is a Pradhan Mantri Fasal Bima Yojana. The new crop insurance scheme is in line with One Nation, One Scheme theme. It incorporates the best features of all previous schemes, and at the same time all previous shortcomings, weaknesses have been removed. The highlights of these schemes are as general, there will be a uniform premium of only 2% to be paid by farmers for all kharif crops and 1.5% for all rabi crops. So, in case of annual commercial and horticulture crops, the premium to be paid by farmers will be only 5%. The premium rates to be paid by farmers are very low, and balance premium will be paid by the government to provide full insured amount to the farmers against crop loss on account of natural calamities. There is no upper limit on government subsidy. Even if the balance premium is 90%, it will be borne by the government. Earlier, there was a provision of capping the premium rate, which resulted in low claims being paid to farmers. This capping was done to limit government outgo on the premium subsidy. So the capping has now been removed, and farmers will get claim against full sum insured without any reduction. The use of technology will be encouraged to a great extent. Smartphones are used to capture and upload data of crop cutting to reduce the delays in claim payment to farmers. Remote sensing is used to reduce the number of crops cutting experiments. Then the weather-based crop insurance is there. Weather-based crop insurance aims to mitigate the hardship of the insured farmers against the likelihood of financial loss on account of anticipated crop loss resulting from incidence of adverse conditions of weather parameters like rainfall, temperature, frost, humidity, etc. Let us look at risk covered and exclusions. So the risk following risk are leading to crop loss are covered under this scheme. Yield losses. Standing crops on notified area basis. Comprehensive risk insurance is provided to cover yield losses due to non-preventable risks such as natural fire and lightning, storm, hailstorm, cyclone, typhoon, tempest, hurricane, tornado, etc. Then flood, inundation and landslide, drought, dry spells, pest, disease, etc. Prevented sowing on notified area basis in cases where majority of the insured farmers of a notified area are having intent to sow plant and incurred expenditure for the purpose are prevented from sowing, planting the insured crop due to adverse weather conditions shall be eligible for indemnity claims up to a maximum of 25% of the sum insured. Then post-harvest losses, individual farm basis. Coverage is available up to a maximum period of 14 days from harvesting for those crops which are kept in cut and spread condition to dry in the field after harvesting against specific perils of cyclones, cyclonic rains, unseasonal rains throughout the country. On localized calamities, individual farm basis, loss damage resulting from occurrence of identified localized risk, that is hailstorm, landslide and inundation affecting isolated farms in the notified area. A risk and losses arising out of following perils shall be excluded, like war and kindred perils, nuclear risk, riot, malicious damage, theft, act of enmity, caged and destroyed by domestic and or wild animals in case of post-harvest losses. The harvested crop bundled and held at a place before threshing, other preventable risks. So crop insurance schemes are crucial for farmers as it provides insurance covers for their harvest, The farmers grow crops with hard labor. Thus, the government introduced a crop insurance system to protect them from loss of crop damage. The crop insurance scheme aims at mitigating financial losses suffered by farmers due to the destruction and damage of their crops resulting from various risks such as extreme weather, natural disasters, or revenues lost due to the price fluctuations in the agricultural market. The agriculture sector hopes various reforms will be announced by the government. The key expectations of the sector include the following measures. In fact, India has revamped its crop insurance scheme because now the crop insurance is mostly covered by the Pradhan Mantri Fasal Bima Yojana. But crop insurance schemes in India currently have many other schemes like weather-based crop insurance scheme, unified package insurance scheme, coconut palm insurance scheme. So a farmer must compulsorily have coverage under any of these schemes mentioned above to avail of crop loan for the notified crops. However, the coverage under these schemes is voluntary for non-loany farmers. The Indian Union Cabinet has cleared the revamped version of its two flagship crop insurance schemes to mitigate growing climate risk for the Indian farmers. The government has also extended the duration of these two crop insurance schemes, this is Pradhan Mantri Fasal Bima Yojana, and restructured weather-based crop insurance scheme for one more year till 25-26. So a total budget of INR 6,95,158 million has been allocated for these two schemes by the Government of India. So, this is a very good development in the field of agriculture because it is voluntary to subscribe to these schemes for all farmers. However, the farmer must mandatorily subscribe to a crop insurance scheme to obtain a crop loan. The farmers who subscribe to these schemes should pay a maximum premium of 2% of the sum insured for kharif crops, 1.5% for rabi crops, and 5% for annual commercial horticultural crops. The difference between a farmer's actual premium and the payable insurance rate will be shared equally by the state and center. The assessment for crop losses because of non-preventable natural risks will be done on the area approach. There are three levels of indemnity, that is 70%, 80% and 90% for all crops corresponding to the crop risk. Crop cutting experiments will be undertaken per crop or unit area on a sliding scale as provided under the respective schemes. The state government decides and notifies the crop-wise insured sum. The state government changes the insured sum from the first year season to the subsequent year season according to the changes in the minimum support price, scale of finance or farm gate price available for the notified crops. The claim amount will be electronically credited to the farmer's insured bank account. So the decision included the continuation of the Pradhan Mantri Fasal Bima Yojana and restructured weather-based crop insurance scheme. Continuation of the scheme till 25-26 with an outlay of rupees 69,515.71 crore. Large scale technology infusion would be there through the Fund for Innovation and Technology with a corpus of rupees 824.77 crores to be utilized for funding technological initiatives under the scheme, namely Yes Tech or Wind, etc. So the schemes provides an affordable crop insurance product for comprehensive risk cover against all known preventable natural risk from pre-sowing to post-harvest stage. The restructured weather-based insurance scheme covers the insured farmers against loss from adverse weather conditions like rainfall, temperature, wind, humidity, etc. The PMFBY, that is Pradhan Mantri Fasal Bima Yojana, and the restructured weather-based scheme primarily differ in their methodology for calculation of admissible claims by farmers. All farmers, including sharecroppers and tenant farmers growing notified crops in the notified area, can get its coverage. Crop covers are food crops, that is cereals, millets, pulses, oilseeds, annual commercial, annual horticulture crop, etc. The basic cover is the risk of yield loss, that is add-on covers based on specific needs. Post-harvest losses maximum to 2 weeks after harvesting, localized calamities, etc. Premium paid by farmers: Kharif crop 2%, Rabi crop 1.5%, commercial horticulture crop 5%. Exclusions: losses arising out of war and nuclear risk and other preventable risks. The National Crop Insurance Portal for better administration and coordination is provided. This comes under the key efforts towards technological advancement under the scheme. Yield estimation system based on technology is called Yes Tech for direct estimation of yield at Gram Panchayat level. Weather information network data system for generation of long-term hyper-local weather data for crop insurance. The implementation of winds to assist state government will begin in 24-25. So plenty of benefits of crop insurance are there because it will help to develop crop production as the insurance provides financial support in case of a crop failure event. It encourages farmers to adopt higher technology or progressive farming practices in agriculture. It helps farmers maintain the flow of agricultural credit. It streamlines the loss assessment process and helps to build an accurate statistical base for crop production. There is a tax exemption on the premium payable by a farmer against the purchase of a crop insurance policy. So the farmers can get a crop loan at low interest rates when they avail of a crop insurance scheme. The country's economy will strengthen since farmers can repay their loans with reimbursement received under the crop insurance policy. Now all farmers are eligible to take the crop insurance scheme in India, including sharecroppers and the tenant farmers. However, they need to grow the notified crops in the notified areas provided under these schemes. The risk covered under the crop insurance schemes are basic cover that covers yield losses to the standing crop due to non-preventable risks like disease attacks, dry spells, landslides, drought, storm, inundation, flood, cyclone, hailstorm, and natural fire due to lightning. Then prevented planting risk, sowing, germination. It provides cover against any problem in sowing or planting because of adverse seasonal conditions or deficit rainfall. Mid-season adversity, it provides relief to farmers against losses occurring due to adverse seasonal conditions where the expected yield during the season is below 50% of the normal yield. Post-harvest losses, it covers losses for up to a maximum of 2 weeks from harvesting. Localized calamities, it covers losses against localized calamities and risks like landslide and hailstorm affecting isolated farms in the notified areas. The losses arising from war, nuclear risk, malicious damage, and other preventable risks are excluded from the insurance cover. So the types of crops covered under crop insurance schemes are food crops such as pulses, cereals and millets, oilseeds, annual commercial or horticulture crops. So farmers can additionally get coverage for the commercial crops, perennial agriculture for which the standard methodology for yield estimation is available. Crop process is very simple, but the crop insurance scheme helps farmers in their time of need. The farmers can adopt advanced agricultural techniques without worrying about losses when they have taken the crop insurance schemes. Though taking these insurance schemes is voluntary, it is highly recommended as it protects the farmers from losses occurring to their crops. Thank you very much.